You've probably heard this a million times. Don't throw good money after bad. Basically, ignore what you've already spent and just focus on the future. But what if that's not always the best advice? Today, we're going to dig into the sunk cost fallacy and ask a really interesting question. Is it always a mistake?
Okay, so let's start with something I bet you've done. You're at a restaurant, you're stuffed. I mean, you can't possibly eat another bite, but you look down at your plate and you force yourself to finish it just because you paid for it, right? Or maybe you sat through 2 hours of a truly awful movie. Why? Because you bought the ticket. That feeling, that nagging voice in your head telling you not to waste what you've already spent, that is the sunk cost fallacy in action.
So, what's the textbook definition here? Well, the sunk cost fallacy is basically our weird human tendency to keep going with something, whether it's a project, a relationship, or that terrible movie, just because we've already sunk money, effort, or time into it. The thing is, that investment is gone. It's sunk. You can't get it back. And, classic economic theory says it should have absolutely zero influence on what you do next.
All right, let's kick things off with the classic take on this whole thing, which you probably know as throwing good money after bad.
And man, once you start looking for it, you see the psychological trap everywhere. It's that manager who keeps pouring resources into a failing project because, hey, they've already spent 6 months on it. It's the investor who won't sell a stock that's tanked because they just can't bring themselves to make that loss real. And it gets personal too, like staying in a relationship that's not working just because of all the years you've already put in.
This quote really nails the why behind it all. See, it's not just about not wanting to be wasteful. It's deeper. It's about justifying our past choices. We keep going, not because it's a good idea for the future, but because we desperately want to prove to ourselves that we didn't make a mistake back then. It's all about keeping up this story that we're smart people who make good decisions.
Okay, but here's where things get really interesting. What if this isn't the whole story? What if this thing we call a fallacy is sometimes the rational thing to do? The lines are about to get a little blurry as we look at the consumer's calculation. So you've got this real clash of ideas going on here. On one side, you have traditional economics, which is super clear. Forget the past, only future costs and benefits matter, period. But on the other side, you have this idea called bounded rationality, and it says, hey, hold on. In the real world, people aren't supercomputers. We use mental shortcuts, heuristics to make life easier. And maybe, just maybe, looking at our past investments is one of those shortcuts that can actually be pretty smart.
Think about something like Amazon Prime. Millions of us pay a pretty hefty fee once a year. That's not a cost for any one thing you buy. It's one single upfront investment that's totally sunk the moment you pay it. And for that, you get a whole bundle of stuff. Free shipping, movies, the works. And here's the kicker. That upfront payment totally changes how we behave. A study found that 61% of Prime members admit they buy stuff they wouldn't have otherwise. And why do they do it? Simple. To get their money's worth out of that fee. They are actively letting that sunk cost dictate what they buy next. It's not just Amazon. You see the same thing in Germany with their Bahncard 50. You pay a big annual fee, and boom, all your train tickets are half price. That initial sunk cost completely changes the math in your head. Suddenly, the cost of taking a train feels as cheap as just hopping in your car. It's a really powerful way to pre-commit yourself to taking the train more. So you might be thinking, are companies just taking advantage of our psychological quirks? And yeah, maybe, but it's way more fascinating than that. It turns out this fallacy can actually become a winning business strategy. Now, get ready for this, because this idea from economic research is totally counterintuitive. It says that in some markets, a company that does the wrong thing, that factors its sunk costs into its pricing, can actually make more money than a competitor who plays by the book. So how on earth does that work? Let's walk through it. Imagine a company makes what we'd call a mistake. They include a big sunk cost, like the price of a new factory when they're setting their prices. So naturally, their prices go out. Now here's the crucial part. Their competitors see this. And instead of undercutting them and starting a price war, they often just raise their own prices to match. And the result? The whole market settles at a higher price point and everybody makes more money. That initial mistake basically acted as a secret signal to everyone to raise their prices. So you'd think competition would stamp out this kind of irrational thinking, right? But what these researchers found was the exact opposite. The market can actually reward the sunk cost bias. The companies that act this way make more profit.
and their rivals quickly learn it's better to join them than to fight them. It's kind of like survival of the most biased. Now, this little trick doesn't work everywhere. It's got to be just the right conditions. For a monopoly, there's no one to signal to, so it's useless. And in a market with a million identical products, if you raise your price, your customers will just leave. The sweet spot is in those markets where there are just a few big companies competing, what economists call an oligopoly. Okay, so where does all of this leave us? We've got to circle back to that big question we started with. Is this whole thing a fallacy, a mistake we make, or is it sometimes a useful feature? We started out with that simple rule you learn in Econ 101, always ignore sunk costs. But now that we've seen how real people and real companies actually behave, well, the answer is obviously not that simple. It's a classic case of it depends. The big takeaway here is that context is absolutely everything. For that one-off decision like finishing the bad movie, yeah, that's still an irrational fallacy. You should just leave. But for something like a Prime subscription, it can actually be a rational way to commit yourself to using a service. And for a business in the right kind of competitive market, it can be a super profitable strategy. What looks like a bug in one situation is actually a feature in another. So the real skill isn't just memorizing the rule, ignore sunk costs. It's having the wisdom to know when that rule just doesn't apply. And that leaves us with one last thing for you to think about. What sunk costs in your own life, in your work, your subscriptions, even your habits, are quietly influencing the choices you're making today?